As you know, taking income and or cash flow throughout the month and simply depositing it into your checking or savings account means that that money is doing very little to work for you. It's that very notion that got us rethinking the behavior of typical savings, including emergency reserves. Instead, what we started doing was looking for better ways of putting that money to work for us versus giving the banks the ability to benefit from fractional reserve banking. That meant parking the income. So let me give you a perfect example that I encountered last week with an audience member from here on YouTube. Roger had $11,000 in high interest credit card debts. This was a result of some unexpected home repairs that he had to make last summer when his basement flooded unexpectedly. So he needed quick access to money to make the repairs, and he didn't want to draw from his emergency funds or his retirement accounts. Not only were his credit card accounts affected, but it immediately played a role against his credit scores, bringing them down to a 672 and a 681 due to the utilization on the cards. But the loans would end up ultimately costing him over $12,700 in interest costs if he stayed on the same path. Now, the good news is that his income is quite strong. He takes home about $4,500 every 2 weeks. But because of his lifestyle, his high mortgage payments, and his student loan debts, his cash flow that he's left with at the end of each month averages at about $700, which he's been using for the past 11 months to rebuild his savings. Now, after our call last week, Roger started Paycheck Parking instead. First, instead of allowing his $700 in cash flow to feed his underperforming emergency fund in his savings account, he took his paycheck last Friday and parked the entire $4,500 against one of his accounts, which paid it off in full. He also pulled $3,000 that he had sitting in savings and applied it towards his final credit card, leaving him just $5,000 in the bank to pay his mortgage and student loans for the month and still have some cushion. This left him only $3,500 in high interest credit card balances and one credit card completely free and clear, which we're now going to be using for all expenses throughout the month. Aside from expenses like his mortgage and his student loans, along with some utilities, 90% of all of his other expenses that he pays throughout the month can actually be paid for with that credit card. And because we're going to be paying it off free and clear every month, he'll now no longer have any interest costs associated with that account. The roadmap consists of Roger taking his next paycheck and also parking that against the $3,500 that's still outstanding, which due to the interest is now going to be closer to $3,560, which leaves him $940 at the end of that pay period, along with the other $4,500 to pay off the expenses that were added to the credit card throughout the month. The net outcome of his parking this income against his debts versus into his savings accounts, as he was doing, and then waiting until his expenses came up to pay them, is that of the $220 per month in savings, most of it was interest. And he now will have a far superior credit score. Because of the negative impact the credit hit had to his insurance, along with some of the other more obvious leaks that we helped him with in that call as well, Roger managed to actually drive his cash flow following our conversation up to a whopping $1,200 every single month after just one call. So that's a 71% improvement to his monthly results without any changes to his earnings or his lifestyle. As these results take effect, we expect Roger's credit scores to jump by more than 100 points where they were previous to his utilization of these credit card accounts, which will allow him access to reserve replacement debt weapons, which will allow him to have large sums of liquid reserves at any time. And by shifting his focus to the student loans and the mortgages next and putting his hard-earned money to work throughout the month as many days as possible, as opposed to working for the banks, we're expecting every single dollar that he owes to be paid in full in under 8 years. In conclusion, the money that's sitting in checking and savings, even emergency reserves, is being wasted. Fractional reserve banking is the practice whereby a bank accepts deposits, makes loans or investments, but is required to hold reserves equal to only a fraction of its deposit liabilities. Banks can lend up to 9 times what you deposit into your checking and savings accounts, which means that every dollar you put into those accounts is working for the banks and not working for you. If you would rather help the banks, great. If you would rather help yourself, then you need to start Paycheck Parking right away. I appreciate your viewership very much. We look forward to seeing you on the next video. Until then, make it a great day today and take care. So in the next 5 minutes, I'm going to show you how you can pay off your entire mortgage free and clear in under 6 years. Now, in today's example, we're going to be looking at a national average mortgage amount of roughly $180,000 with a conservatively realistic interest rate of 5%. This is amortized over a full 30 years, which is the most common term. And we're going to start this loan in January of 2018.